Lookiesoft web-based warehouse inventory management system application. Warehouse inventory management system. The extensive functionality of Lookiesoft logistics and inventory management makes possible the successful planning and control of your inventory flow. It maintains an archive of the entire stock transactions taking place, providing the company real-time information on inventory levels across units. Management is to supply materials of the right quality, in the right quantity at the right time, both to internal as well as external customers. Lookiesoft Logistics and Inventory Management provides a systematic approach of furnishing accurate information to the right person with a view to assist him in optimizing the available inventory resources. It is an effective tool giving information about stock transactions, delivery dates, and historical and future anticipated consumption. Its extensive reporting system gives overall inventory status across the enterprise. Inventory resources of an organization consist of raw material, packing material, general stores, semi-finished goods, finished goods, and capital goods, which in Lookiesoft inventory can be classified under stock group, stock type, and stock category in a hierarchical structure. In Lookiesoft logistics and inventory there are certain master definitions such as go down, storage location, definition based upon different stock groups, item definition, and package definition. The objective of inventory management is to supply materials of the right quality, in the right quantity at the right time, both to internal as well as external customers. Lookiesoft Inventory Management provides a systematic approach of furnishing accurate information to the right person with a view to assist him in optimizing the available inventory resources. It is an effective tool giving information about stock transactions, delivery dates, and historical and future anticipated consumption. Its extensive reporting system gives overall inventory status across the enterprise. Inventory resources of an organization consist of raw material, packing material, general stores, semi-finished goods, finished goods, and capital goods, which in Lookiesoft inventory can be classified under stock group, stock type, and stock category in a hierarchical structure. Lookiesoft Logistics and Inventory Management System, ICS, is designed as an integrated business management system for optimizing and control of all inventory transactions and management processes using information technology, IT, solutions. ICS application is web-based software solution built to effectively and efficiently manage all inventory management processes of companies and organizations. The system manages all inventory transactions such as receiving, delivery, disposal, stock level control, cost and price adjustment, purchasing and budgeting, vendors and customer-related data and controls process activities to enable all of the business process done with optimum results. The system supports for multiple warehouse, unit of measure and currencies. For management overview, the system is facilitated with a dashboard display both on graphical and numbers presentation of various data related to inventory transaction process and tracking every detail and status etc. Details report and analysis data in both graphical and numbers are also available for other functional modules, such as user transaction data etc. ICS Inventory Lifecycle Management application is designed to suite all logistics and inventory related process to companies or organizations that meets most of these requirements. Application concept. The concept of inventory management system application as described here is essential to materials management function. The definition of inventory and various types of inventories such as raw materials, finished goods, in-process inventory, MRO inventory, etc. are outlined. The need to keep inventory and the functions of inventory as a decoupling agent to enable various subsystems in a supply chain to be decoupled are described. The inventory-related cost parameters are listed along with methods of estimating these. Other situational parameters like demand and lead times also need to be estimated. Before an inventory model is employed for optimal operation of the inventory system, an appropriate inventory policy has to be selected. 3 types of inventory policies are described, and their relative strengths and weaknesses are discussed. A taxonomy of inventory models is presented to give an overview of a plethora of inventory models available in inventory management literature. However, the right choice of the inventory model is crucial for the success of inventory management. What is inventory? Inventory or stock, in common terms, is considered to be the central theme in managing the materials. The inventory turnover ratio, ITR, is a barometer of performance of materials management function. In the generally understood term, inventory means a physical stock of goods kept in store to meet the anticipated demand. However, from materials management perspective, the definition of inventory is a usable but idle resource having some economic value. This brings to the fore a paradox in the concept of inventory perceived as a necessary evil. It is necessary to have physical stock in the system to take care of the anticipated demand because non-availability of materials when needed will lead to delays in production or projects or services delivered. However, keeping inventory is not free because there are opportunity costs of carrying or holding inventory in the organization. Thus, the paradox is that we need inventory, but it is not desirable to have inventory. It is this paradoxical situation that makes inventory management a challenging problem area in materials management. It also makes a high inventory turnover ratio as a desirable performance indicator. Supported types of inventories. ICS Logistics and Inventory Management System is employing the generic definition of inventory. A large spectrum of situations can be structured as inventory management problems. These include the following. 1. Raw materials inventory as input to manufacturing system. 2. Bought out parts, BOP, inventory which directly go to the assembly of product as it is. 3. Work in progress, WIP, or work in process inventory or pipeline inventory. 4. Finished goods inventory for supporting the distribution to the customers. 5. Maintenance, repair, and operating, MRO, supplies. These include spare parts, indirect materials, and all other sundry items required for production/service systems. It may be noted that the basic definition of inventory being a usable but idle resource remains valid irrespective of the type of inventory being managed. Why do we need inventories? From the resource management point of view, we should not have inventories as these constitute the idle resources. However, if we did not have inventories, there will be shortages, production delays, and project delays. Some of the reasons for having inventories in the production/service system are as follows. 1. Time lag between placing orders and getting supplies at the point of consumption. Whenever we place a replenishment order, there is a time lag between placing the order and getting the materials at the point of use. This is called replenishment lead time. In most cases the lead time is non-zero, and at times it is quite high. This necessitates holding of inventory to take care of demand during the lead times. 2. Variability of lead times. In most cases, particularly in Indian supply environment, there is some degree of variability in lead times because the supply environment is perhaps just in case, JIC, type. Inventory has to be maintained as a shield to cope with the supply uncertainty. Inventory is the premium an organization pays for operating in a just-in-case supply environment. If there was no such uncertainty and if demand and supply are deterministic, then in just-in-time, JIT, type environment, no or low inventory will be required. The greater the amount of supply uncertainty, the greater the amount of additional inventory required. 3. Demand variability. If either we are unable to estimate the demand correctly or if there are uncertainties in demand, additional inventory will be required to act as a shield to absorb the demand variability. The greater the demand variability, the greater the amount of additional inventory required. 4. Seasonal inventory. If the demand is cyclic or seasonal, then sometimes building inventory in the lean period to meet the peak period demand is employed as a strategy in aggregate production planning. This strategy results in inventory in some part of the year. 5. Pipeline inventory. This is the inventory due to the distribution of a product or a commodity over long distances, so that the goods in transit become substantially important. This constitutes the pipeline inventory. In the context of production processes, this is called in-process inventory or work in progress, WIP, which is also inventory in terms of idle resource blocked in the non-productive form. This can be reduced by making the supply chain move faster. 6. Other factors. Sometimes inventory is maintained to take care of other situational parameters such as inflationary pressures, shortage of materials in the markets, and quantity discounts to encourage bulk purchasing, or simply the desire to spend the budget allocated for materials before the end of the financial year, resulting in large and at times unnecessary purchases which eventually become dead stock. Just-in-time or zero inventory essentials. Just-in-time, JIT, is one of the most talked about topics in materials planning, primarily due to its tremendous success in the context of Japanese companies. JIT or Zero Inventory System is an idealized concept of inventory management wherein we are able to supply whatever material is required, wherever required, and whenever required, just in time with 100% supply assurances without keeping any inventory on hand. Obviously, from the resource management point of view, nothing can be better than this, as there are no inventories, no shortages, and no replenishment orders placed. However, this concept necessitates that the suppliers, vendors, are local and are 100% dependable. Orders splitting with small orders without additional transportation costs is feasible, i.e., frequent deliveries are economically viable, and the requirements are firmly known. This also calls for a single vendor base and having long-term relationship with the vendor, who has to be a quality vendor. This also requires that the vendor has sufficient capacity to supply anytime without passing on the costs of overcapacity to the buyer. This similar illustration has shown that the supply of oxygen to the human body is perhaps the perfect example of a JIT/zero inventory system, and from this analogy, a number of prerequisites for the success of JIT can be visualized. In uncertain demand and supply environment, JIT is not feasible. Thus, inventory management in uncertain supply environment is JIC type, in which minimization of the total expected system cost becomes an important objective. Functions of inventory. A mechanical analogy. In order to gain further insights into the function/role of inventory in an organization, a mechanical analogy has been proposed. This perceives the role of inventory as to decouple the two subsystems, so that a subsystem is not directly coupled to another subsystem. Specifically, the mechanical analogy is from a mass dashpot or a mass spring systems used in mechanical vibrations. It is known in mechanical systems that the role of a spring or a dashpot or shock absorber is to absorb the vibrations caused by imbalance of forces in a dynamical system, so that these are not allowed to be passed on to the other subsystem. The analogy of such mechanical systems with the inventory. In a directly coupled system, the vibrations in a subsystem get transferred to another subsystem. A spring/dashpot or a shock absorber decouples it to an extent. Similarly, in an organization, inventory of raw materials or bought out parts decouples supply subsystem from production subsystem. This means that even if supply disruptions take place, raw materials inventory will enable production operations to go on up to a limit. Similar decoupling function is provided by in-process inventory to decouple one department or a machine from the other. The finished goods inventory decouples the production subsystem from the distribution/sales subsystem. The spares inventory decouples the maintenance subsystem from the production subsystem. By developing this analogy further, the design of the mechanical spring/dashpot/shock absorber will depend upon the degree of imbalance and the amplitude of vibrations. The greater the extent of vibrations, the stronger is the spring design required for a stated level of decoupling desired. The higher the decoupling desired, the more robust the design of the spring and hence the costlier it will be. Seen in this perspective, optimal inventory level is analogous to optimal design of the mechanical spring or the shock absorber. Thus, inventory is required in an organization to absorb the vibration caused by uncertainties of demand and supply to provide a required degree of decoupling, level of service. What is an inventory problem? It is suggested that we have an inventory problem when we need to decide about a. When to initiate a purchase order, when to buy, and b. How much to buy. Determine the lot size. In solving these twin problems of decision making, we need to develop a model of inventory. A rational scientific approach to decision making calls for developing an inventory model which links up the objective function with the decision variables, example lot size and reorder point, and various inventory related cost parameters, as well as situational variables such as demand, uncertainty of demand, lead time, uncertainty of lead time, constraints, if any, and any other relevant data such as quantity discounts or inflationary trend. An inventory model is a model which attempts to link up primarily the following three types of inventory-related costs in which at least one is subject to control. In decision-making models, at least one variable must be controllable, otherwise, it is only descriptive model of the system. The three costs are as follows. A. Inventory carrying costs or holding cost. This is the estimated or imputed cost of holding or carrying a unit of material in the form of inventory for a unit period of time. This is a function of the price of the material held in stock per unit and a fraction of carrying charge expressed as a fraction or percentage of unit price/unit time. The carrying cost is expressed as per unit/unit time. For example, if the material cost is 1,000 per unit and if the fraction of carrying charge is 0.25 per year, then the unit carrying cost is 250 per unit/year. The fraction of carrying charge is contingent upon a number of situational parameters which will be detailed out in the next section, but the cost of capital blocked in the non-productive form, which inventories are perceived to be, is the most dominant component. This in turn requires a method of estimating these costs. B. Cost of shortage or stock out. This is the estimated or imputed opportunity cost incurred if we do not have materials in stock when the demand arises. This depends upon the consequences of such a situation to arise. If we lost a customer, then it will be the opportunity cost of lost sales. If the demand remains backlogged, or backordered, then this will be the penalty cost, if any, loss of goodwill, cost of production or project delays, etc. Estimating the shortage cost is relatively more difficult than the carrying cost, but an approximate estimate is better than ignoring such costs altogether. C. Ordering costs. Ordering or replenishment costs are the costs of efforts put in and expenses incurred when a purchase order is initiated for procurement or replenishment of inventories. The ordering cost is quite dependent on the purchase procedures and the extent of bureaucracy and paperwork involved in the processing of a purchase order. This includes administrative efforts expended in paper flow, progress chasing, inspection, and other costs which will be detailed out in the next section. However, for the sake of simplification, in many inventory models, the ordering cost is assumed to be independent of the order size and is expressed as per order. Though it may not be strictly true, yet many inventory models are developed assuming this as an approximation of reality. This has denoted these costs as C1, C2, and C3, respectively. Though not a standard notation, these notations will be used throughout in this book for the sake of uniformity. Estimation of inventory-related cost parameters. Estimated or imputed costs are relevant inputs to models of decision-making for rationalizing inventory policies, and hence it is important that these are properly estimated. These costs are situation-specific and may be different for different items, even for the same organization, depending upon the nature of the item, its perishability characteristics, any special storage conditions required, and the impact of non-availability when needed. The following discussion will perhaps enable the materials planners to estimate these costs more appropriately. Cost of carrying inventory, C1. These costs need to be realistically estimated on the incremental costing basis to include those costs elements which vary directly with the amount of inventories held. These costs can be divided into the following four subcategories. 1. Capital costs. These include the opportunity loss due to the return on investment of this fund in an alternate way, if it is own capital, or the interest paid on the borrowed capital, cost of capital, This is the most dominant component of carrying cost and may nearly be half of the total carrying cost. 2. Storage costs, costs associated with the need to house inventories in a physical storage facility. The cost components could be amortized cost of land, building, storage equipment, and creating special storage environment like temperature and humidity control, and costs due to leasing or renting storage space or depreciation, insurance, taxes, utilities, etc. 3. Service costs, cost of hiring persons to process inventory transactions, materials handling, receiving and storage, retrieval and issue of physical inventory, and any other cost of service. 4. Risk costs, these are associated with the risk of obsolescence or shrinkage of inventory due to pilferage, spoilage, damage, disappearance, such as evaporation during storage, stock-dependent consumption, and perishability or devaluation of selling price. Depending upon the nature of item stocked, the carrying cost may vary from 15 to 50% of the value of stock per year. In highly perishable situation, it could be even more. In many illustrative examples, a figure of 25% is assumed. However, it is only an illustrative figure. The actual cost may be estimated specific to the item. Love, 1979, has cited studies suggesting that the companies generally underestimate the carrying costs and that the capital cost is roughly 50% of the total cost of carrying inventory, while the remaining 3 categories are essentially comparable. A simple heuristic way to estimate carrying cost would then be to double the cost of capital blocked in inventory and add extra for additional risks involved due to pilferage, perishability, obsolescence, stock, dependent consumption rate, etc., as the case may be. Cost of shortage, C2. Cost of shortage is the opportunity cost of not having materials when required. This includes tangible and intangible cost components and is relatively difficult to estimate. In inventory models, it is divided into 2 categories: when the backlogging is allowed and when a shortage leads to lost sales. Under the backlogging, or backordering, situation, it is estimated as number of unit short and the duration of the backlogging. Thus, it is expressed as C2/unit short/unit time. The shortage cost could be estimated on the basis of 4 possible scenarios as follows. 1. When remedial action is possible for a purchased item to prevent shortage, such as emergency purchase with cost consequences of premium material price, loss of purchase quantity discount, extra ordering cost, and rush shipment. Alternatively, it could mean the use of a substitute item, which may be of higher cost, including any adaptation costs. 2. Remedial action for manufactured item in preventing a shortage is to give overtime at higher rate, subcontracting, emergency hiring, inferior quality, or use of a substitute item. 3. When no remedial action is possible in the case of purchased item, it includes the extra costs due to penalty cost of late deliveries, special delivery when item arrives, loss of goodwill, lawsuit, extra paperwork, and long-term loss of customers. 4. When remedial action is possible to prevent a shortage in manufacturing context, it includes opportunity cost of production downtime, idle labor, equipment, failure to meet delivery schedules, and unsafe conditions resulting in losses and damages. In the case when backlogging is not allowed, shortage results in lost sales and the unit of C2 changes to /unit short. The opportunity costs of lost sales are loss of contribution margin, lost customers in the future due to loss of goodwill, etc. Though estimation of shortage cost is difficult, yet it must be recognized as a factor relevant to inventory planning, because some concern for shortage cost is better than no concern. It is quite obvious that the range of variation of C2 is quite high, from minor irritation or inconvenience to catastrophic failures. However, from the perspective of prevention and failure costs computed under cost of quality in TQM literature, one can roughly estimate that normally shortage cost could be 10 times the cost of carrying inventory C1. Thus, C2/C1 ratio could be 10 in many situations, but it is only an imputed cost. However, the organization's concern for customer satisfaction, which includes on-time deliveries, is an important policy variable for estimating shortage cost. For a customer-sensitive company, C2/C1 ratio is high. There may be a wrong perception that being a difficult to measure cost, shortage cost should not be included in the inventory models. Such an assumption indirectly attributes a cost value to the shortage cost. If we ignore it altogether, then we are imputing value of C2 However, if we say that being of serious concern in inventory planning, we should not allow shortages to occur, in that case we are imputing infinite cost to shortage at C2 Both these extremes are not good. Hence, a normal, C2/C1, ratio of may 10 be taken as a rough guide, and it may be adjusted on either side of this value depending upon the specific situation. For vital or critical items, it could be more than 10, and for desirable items, it could be less than 10. We may alternatively prescribe service levels to impute this cost. A desired level of service may be easier to prescribe but eventually gets translated to imputing a value to shortage cost C2. Hence, either way, it is acceptable. Of C, ordering cost, C3. The cost of ordering, C3, is also called as cost of replenishing an order. For manufactured item within the company, it may have the same meaning as the cost of production setup. For the purchased items, it is the administrative cost of processing the order for approval, order placement, paperwork, communication, shipment, freight, postage, demurrage, pickup, cost at the time of receiving the shipments, paperwork, document preparation, materials handling, inspection, billing cost, which includes the labor and overhead costs. A detailed checklist of tasks required to process an order and attributing costs to it can help. One of the biggest advantages of e-procurement is the reduction in paperwork and reduced internal lead time of replenishments. Since ordering costs involve identifying specific tangible activities in the procurement process, this cost is relatively easy to estimate as compared to the cost C2 or C1. C3 also depends upon the process of procurement. If it is manual and bureaucratic, then C3 is high. Alternatively, if it is simplified and computerized, it may be quite low. These costs are assumed to be fixed and expressed as C3 1/4/order, independent of the order size. Inventory models. An inventory model attempts to represent an inventory problem to facilitate decision-making. Typically, the inventory model enables us to rationally decide A. How much to buy, B. And when to buy. In order to answer these questions, we need to develop inventory model which combines decision variables with situational parameters. The situational parameters are demand, lead time, C1, C2, and C3, unit purchase price, and any uncertainties associated with demand and lead times. It may also include any special features such as quantity discounts, inflationary factors, budget or space constraints, etc. Nader, 1966, defines inventory model as a mathematical relationship which involves three inventory-related costs C1, C2, and C3, and at least two of these should be under control. If all the three are subject to control, it is termed as type 1, 2, 3 inventory model. If C1 and C3 are relevant, C2 1/4, then it is type 1, 3 inventory model. There have been different approaches to classify inventory models. These have been differently classified by various authors such as Nader, 1966, Love, 1979, Starr and Miller, 1975, and Fabrici and Banks, 1967. Hollier and Vratt, 1978, proposed an approach to classify the inventory models depending upon the decision variables and the situational parameters, including the inventory policies employed as operating doctrine in the management of inventories. Inventory policies. Inventory policy is an operating framework or a standard operating procedure, SOP, in implementing an inventory model. Obviously, the inventory model will depend upon the choice of inventory policy adopted. Typically, an inventory policy results in an inventory graph as a function of time. This visually depicts how the inventory status changes over time and when does procurement intervention take place. In practice, 3 inventory policies are normally employed. These are described as follows. Economic order quantity, of EOQ, reorder point, ROP, policy. Under this policy, the inventory status is continuously monitored. Whenever the inventory level falls to a predetermined level called as reorder point, ROP, a replenishment order of fixed quantity called economic order quantity, EOQ, is placed. Thus EOQ, Q, and ROP, R, are the 2 decision variable involved in solving the problem of how much to buy and when to buy. Figure 2 shows the graphical operation of the Q, R, policy. Such inventory model must have Q, R, as decision variables. Since this policy requires that the inventory levels be continuously monitored, it calls for keeping a constant watch at stock levels, while in a computerized inventory control, it is easy. In manual systems its administrative costs of operation could be more. To ease this situation, a very ingenious method of manual monitoring of this policy has been evolved and is in practice for long and is called the 2-bin policy. Under the 2-bin policy, total stock is kept in 2 bins. The second bin keeps the stock required during the lead time, and the first bin contains the Q minus the stock in the second bin. The consumption is met from the first bin until it gets totally consumed. The moment it happens, the reorder point is deemed to have been reached, and a replenishment order of size, Q, is placed. During the replenishment period, the demand is met from the second bin. Of course, with the computerization of inventory records, the stock status can be continuously monitored easily without the 2-bin policy, because in the 2-bin policy one has to keep 2 storage units for each item. EOQ policy is perhaps the most talked logistics and inventory management system is about policy in inventory control literature and is the oldest scientific model of inventory control. Periodic review inventory policy. The stock status is periodically reviewed under this policy after a fixed time interval, T. When the review period is reached, the order is placed which is determined by the following relationship Q 1/4 order quantity 1/4 SX where S 1/4 maximum stock level, or order up to level, X 1/4 stock on hand at the time of review. Figure 3 illustrates the periodic review policy graphically. Under this policy, S, the maximum stock level and the time interval between 2 reviews, T, are the 2 decision variables for optimization. Therefore, it is also called as S, T, policy. Operation of this policy is relatively easy because status of inventory is taken only after a fixed time interval. However, this policy is quite sensitive to the consumption during the review cycle. If stock then on hand is high, the order quantity for the next period is low and vice versa. However, under this policy, an order has to be mandatorily placed even if the stock levels are quite high at the review period, due to which the order size is a small quantity. In order to simplify the model, one may specify one of the decision variables S or T. Nader, 1966, called it SP, T, policy if S is prescribed and T is the only decision variable. If T is prescribed, then it is called S, TP, policy with S as a decision variable. Optional replenishment policy. This is a variant of periodic review inventory policy wherein there are 2 levels of inventory identified as S, the maximum level, and S, the minimum level. The stock levels are periodically examined at fixed time interval T. However, if the stock levels are more than the minimum level, S, at the time of review, the replenishment decision is deferred to the next review cycle, and no order is placed because the current stock is deemed to be adequate for the time being until the next review cycle. If, at the time of review, the stock level, X, is less than or equal to S, then the order quantity Q is determined so that it raises the stock level to S. Thus under this policy, Q 1/4 SX if X S 1/4 0 if XS. Figure 4 depicts the operation of this policy graphically. This policy is also called as minimum maximum stock level policy or S policy. Here the decision variables are S, and T. This is also called as optional replenishment policy because there is an option of skipping the replenishment decision to the next review period if the current inventory on hand is more than the minimum level prescribed. Thus, intuitively, this would appear to be better than S-T policy provided S, and T are optimized. There may be other variants of these three basic policies, but the most common policies are only these. The inventory model to be developed depends upon the choice of inventory policy. Hence, we have to first decide the inventory policy to be employed before we develop an inventory model for optimal choice of the decision variables. It has been shown in the inventory control research that if S, T are optimized, then the optional replenishment policy is the best among the three policy options outlined above. However, as will be seen later, optimization of these three decision variables simultaneously leads to a very complex model of inventory in case of probabilistic demand and lead times. For practical purposes, EOQROP policy is a good choice for high usage value items, while S-T policy is good for low usage value items. S policy may be employed for very high usage value items where modeling complexity will be justifiable even if one may have to resort to simulation to optimize decision variables. Taxonomy of inventory models. There is enormous amount of scientific literature available on inventory models. It is difficult to compile and present all these models in a single treatise. However, a structured portrayal of the taxonomy of these models gives a very good overview of the plethora of inventory models available on scientific inventory management. Figure 5 depicts such a taxonomy in a tree-like structure. These models can be broadly classified as single purchase decisions, static models or repetitive purchase, dynamic models. Other major grouping could be deterministic inventory models versus probabilistic inventory models. Further branching can be done on the basis of number of items, single versus multiple, number of sources of supply, single versus multiple, number of echelons, single versus multi-echelon, and other situational variables such as quantity discounts, budget constraints, etc. In this book, we will attempt to discuss some of these inventory models, but an exhaustive coverage is neither possible nor desirable in a single book on inventory control. Unfortunately, particularly in developing economies, these models are not frequently used, and paradoxically, a huge number of inventory models in research literature remain itself as inventory, a usable but idle resource, due to non-implementation of these. Summary and concluding remarks. In this chapter, the concept of inventory is discussed, which is central to materials management function. The definition of inventory as a usable but idle resource is highlighted, and various types of inventories, raw materials, finished goods, in-process inventory, MRO inventory, etc., are outlined. The need to keep inventory is detailed, and function of inventory as a decoupling agent is illustrated through a mechanical analogy. Inventories enable various subsystems in a supply chain to be decoupled to a certain extent as a dashpot or a shock absorber decouples two mechanical subsystems. The inventory related cost parameters are listed along with methods of estimating these. Other situational parameters like demand and lead times also need to be estimated. Before an inventory model is employed for optimal operation of the inventory system, an appropriate inventory policy has to be selected. Three types of inventory policies are described, and their relative strengths and weaknesses are discussed. A taxonomy of inventory models is presented to give an overview of plethora of inventory models available in inventory management literature. Some of these will be discussed in detail in the subsequent chapters. However, the right choice of the inventory model is crucial for the success of inventory management. Selective inventory management is necessary because indiscriminate rigor in inventory control for all items could be counterproductive. The next chapter focuses on these issues. Conceptual questions. 1. Why is inventory a necessary evil with uncertain demand and lead time situations? 2. What are the different kinds of inventories? 3. How does inventory decouple various subsystems in a supply chain? 4. What cost factors influence cost of carrying cost? If the item is perishable in nature, what influence will it have on estimating the inventory carrying cost? 5. Why is it more difficult to estimate shortages cost in an inventory system? What aspects are necessary to be captured in such a cost estimation? 6. How does e-procurement and process simplification impact the cost of ordering? 7. What is an inventory model? Which decisions are facilitated by an inventory model? 8. Describe 3 types of inventory policies and compare their strengths and weaknesses. 9. What is JIT? Is JIT realizable in a chaotic supply environment? 10. What are major situational parameters that need to be estimated for the development of inventory models? Inventory management disciplines and interfaces. The disciplines interfacing directly with inventory management and their functional responsibilities are: 1. Capacity management, i.e., PC memory and speed, DASD size, etc. 2. Performance management, speed and usage information. 3. Change management, version and release information, benchmark, testing, etc. 4. Recovery management, recovery planning for critical assets and sizing requirements for recovery facilities. 5. Service level management, service level agreements, SLAs and service level reporting SLR of user processing and service requirements. 6. Problem management, change history, problem history, troubleshooting, pathway, version and release information, etc. 7. Configuration management, hardware, software, location, HVAC requirements, power, water, floor space, fixed assets, etc. The inventory management function is responsible for tracking all assets, from mainframe-based to data network-based, that are connected to the data center or data network. In each case, the inventory management systems must be able to: 1. Identify the asset and its serial number. 2. Associate the asset with its owner and location. 3. Relate the asset to its vendor. 4. Track the maintenance level of the asset, and 5. Provide the asset's problem and change history. The ideal inventory management system should also: 1. Provide financial information related to an asset. 2. Define the criticality of the asset, and 3. Supply history information for the asset. The inventory management system interfaces with the following departments: 1. Finance. 2. Contracts. 3. System software. 4. Technical support. 5. Change management. 6. Production services. 7. Facilities management, and 8. Enterprise management personnel. The nature of inventory. Inventory is an asset held for resale rather than use, and takes different forms. Retailer has single inventory, merchandise inventory. Cost is purchase price. Manufacturer has more than one form of inventory, depending on stage of development. Raw materials, purchased items that have not yet entered the manufacturing process. Work in process, unfinished units of the company's product. Direct materials used to make product. Direct labor paid to workers who make the product from raw materials. Overhead manufacturing costs that cannot be directly traced to a specific unit of product. Finished goods, product ready for sale. Inventory valuation and the measurement of income. Inventory, an asset, unexpired cost, becomes cost of goods sold and expense, expired cost. Beginning inventory plus purchases equals goods available for sale, ending inventory equals cost of goods sold. Error in end inventory figure will give incorrect cost of goods sold, and thus incorrect income. Cost of inventory includes all costs incurred in bringing the inventory to its existing condition and location. Purchase price less discounts. Transportation in. Insurance in transit. Taxes. Storage. Apply cost/benefit test to determine which items to add to cost. Inventory costing methods with a periodic system. Inventory is purchased at different times, and at different prices. These costs must be allocated correctly when items are sold. Specific identification: find out exactly which items were sold. Their actual cost is cost of goods sold. Only correct method in terms of physical flow. Impractical for most retail merchandise. Accountants make assumptions about flow of costs rather than flow of units. Specific identification matches flow of costs to flow of units. May be difficult to keep track of individual units. What if they're nails? Ping pong balls? Cans of peas? Can lead to income manipulation. Sell selected items, depending on their purchase price, to increase or decrease income. Weighted average unit cost equals cost of goods available for sale divided by units available for sale. Results in smoothing of income. FIFO, or first in, first out method assumes that the costs of the first items received, in most cases the beginning inventory, are the first used to cost goods sold. Working forward in time through the purchased goods, ending inventory is costed at the most recently paid prices. Working backward in time. LIFO, or last in, first out, is the opposite of FIFO. Assumes that the costs of the last units purchased are the first to be used to value cost of goods sold. Working backward in time, ending inventory is costed at oldest unit costs available. Beginning inventory. Working forward. Selecting an inventory costing method. Major consideration in selection of method is accurate income reporting. Weighted average is simple. When prices are rising, LIFO puts higher costs in cost of goods sold, resulting in lower income, lower taxes. Ending inventory may be distorted because it consists of older, earlier, costs. This is a deferral, not permanent savings, in taxes because taxes will be paid later when goods are finally sold. LIFO liquidation, company sells more than it bought in a period, thus selling some units with older, relatively lower costs. IRS has LIFO conformity rule. If a company uses LIFO for taxes, it must also use LIFO for its financial reporting. LIFO reserve excess of value of ending inventory if calculated at FIFO rather than at LIFO. This is also the cumulative amount of the increase in cost of goods sold on the income statement over the years LIFO has been used. The difference in the LIFO reserve between any 2 years is the additional cost of goods sold in the current year resulting from the use of LIFO. Tax savings equals the change in the LIFO reserve times the company's tax rate. Inventory profit difference between valuation placed on inventory and its replacement cost, or the profit earned simply by holding inventory during a period of rising prices, particularly notable with FIFO. Some argue that inventory should be valued at replacement cost because replacement cost is more realistic and would eliminate inventory profits. If any cost other than replacement cost is used, part of the profit is not real profit, but dollars that will have to be spent to replace inventory at higher cost, assuming rising prices. Currently LIFO is nearest approximation to replacement cost. Replacement cost approach is not acceptable under current GAAP changing method of inventory valuation. Done if company believes another method would result in better matching of revenue and expense. Must be justified by other than tax considerations. Must be disclosed international accounting for inventory. Rules vary considerably throughout the world. Some countries rarely use LIFO. International standards makers favor the use of FIFO or weighted average, accepting LIFO only if information is given to allow users to reconcile LIFO to FIFO. Perpetual versus periodic inventory systems. Periodic system, used in this chapter, requires a count of ending inventory to determine cost of goods sold. Simpler system. Use of computers has inclined more businesses toward perpetual system, which allows better control. Valuing inventory at lower of cost or market. Lower of cost or market, LCM, rule is applied when the market value of inventory is less than its historical cost. The effect is that the asset, inventory, is reduced and the net income is reduced because of an additional expense on the income statement. Replacement cost is used as measure of market value, thus we should really call it the lower of cost or replacement rule. Report loss in the period when the market price actually declines, real time, not when inventory is sold, which could be in a future period. Loss on decline in value is other expense on the income statement. Normal gross profit when items are sold, lower selling price, lower written down cost. Reflects conservatism principle. LCM is a valid exception to the cost principle. Ways to apply LCM rule. Report lower of total cost or total market value of inventory. Report lower of cost or market for each item. Most popular, required for tax purposes. Lower of cost or market for groups of items and choose a method and apply it consistently from one accounting period to the next. Methods for estimating inventory value. Gross profit method. Gross profit method. Ratio of gross profit to sales is used to estimate inventory that is stolen or destroyed by fire, flood, or other type of damage, as well as for inventory estimation for interim statements when physical count is not practical. Assumes reliable estimate of company's usual gross profit rate. Gross profit is synonymous with gross margin. Subtract estimated cost of goods sold, using gross profit rate to calculate, from goods available to obtain estimated ending inventory. Beginning inventory plus purchases equals goods available. Estimated cost of goods sold, sales, gross profit calculated using usual rate, equals estimated remaining inventory. Analyzing the management of inventory turnover. Inventory turnover, balance between having enough merchandise in stock to meet customer needs, and not so much that cash is tied up unreasonably. Inventory turnover ratio equals cost of goods sold / average inventory. Divide into 360 to find how many days, on average, items stay in inventory. Days equals 360 divided by turnover. Inventory Management System Modules. Admin. * Property Pengana. * Log Pengana. * Licensi Aplicasi. Master Data. * Supplier. * Currency. * Numbering. * Parameter System. * Corporate. * Vendors. * Customers. * Items list. * Warehouse items. * Chart of account. * Currency. * Taxes. * Cost center. * Numbering. * Item group. * Unit. * Korea. * Warehouse rack. * Warehouse sub-rack. * Item type. * Office type. * Position level. * Country. * City district. * Sales personnel. Transaction. * Item incoming. * Item outgoing. * Item disposal. * Item movement. * Item on aim plan. * Item on aim update. * Print item QR code. * Posting GL. Utility. * Delete data. Reports. * Item incoming. * Item outgoing. * Item disposal. * Item movement. * Item list. * Item stock. * Item stock and price. Messaging. * Inbox. * Outbox. * Draft. My account. * Change password. * Change photo. * Change language. * Logs history. Nokiasoft web-based software as services. We offer web-based software as services, SaaS, for your business solution. Nokiasoft, the software engineering services, believes, practices of the software engineering principles and best practices. Our adopted process framework, and our conviction on quality based our own software development experience, enables us to deliver the best to our customers. While software engineering has been around for decades, its adoption leading to business success through improved quality and predictability has been, by and large, a mirage. Software is essentially a construction in mind and, a collective one at that, with many stakeholders of varying interests and skills. Applying the engineering principles is more of continuous refinements of an adaptive process rather than adoption of a prescriptive process. Nokiasoft, with its wealth of acquired knowledge and more than a decade of experience, has specialized in transitioning itself and its customers into sound software engineering practices without undue documentation and technology overheads. We are the only IT consultancy management, design and development, software as services, SaaS, and cloud application solutions. SaaS application on desktop computer. SaaS web-based application will be installed on standalone desktop computer. SaaS application on VPS server. SaaS web-based application will be installed on data center VPS server. SaaS application on _colocation or own dedicated server. SaaS web-based application will be installed on data center with colocation or own dedicated server. SaaS application in-house server. SaaS web-based application will be installed on your in-house server. Professional business application service provider. Software as service, SaaS, provider. Software as a service, SaaS, is a software distribution model in which a third-party provider hosts applications and makes them available to customers over the Internet. SaaS is one of three main categories of cloud computing, alongside infrastructure as a service, IaaS, and platform as a service, PaaS. VPS and dedicated application services. We also offer customers to run our web-based applications with a VPS that runs its own copy of an operating system, and customers may have super user level access to that operating system instance, so they can install multiple applications that runs on that OS. The system working 24 hours with high bandwidth internet connection. Agile software development. Agile software development is a conceptual framework for software engineering that promotes development iterations throughout the life cycle of the project. Website development. Our expert team of website developers and digital strategists use cutting-edge technology and best practices to create custom sites that increase user engagement. We understand that every custom web development project is unique. We want to get to know your brand, understand your needs, and determine an appropriate timeline and project plan tailored to your business. Anwar. Founder, creator and developer. Email, nokiasoft@gmail.com